Hello, everybody. Hope you've been having a good week. So, tax day is on Monday. We are currently filing extensions for everybody. But yeah, April 15th is on Monday. It's getting pretty busy around here right now. So, today I want to talk about a couple of things, and this may or may not become a two-part series. But today I wanted to talk. This came up as a topic in a couple of different emails, and I talk about this usually in initial consultations. But I wanted to really try to define what are active versus passive income for tax purposes, and kind of the benefits or the problems of either one of them. Okay, so and then may or may not throw it in this video, or it'll be in next week's. The different types of revenue streams that can come from active or passive, and if you want to keep them in an LLC or not, or if you want to put them in the same LLC that you're operating in. So that might be next week. So we'll see how fast we go. I can be long-winded. I am a CPA. You know, I like to talk. I like to hear myself talk, I think. So it's okay. Okay, so what is active income? Active income means that you are actively, and it's really bad to use the same word to define it, right? So you are actually engaged in earning that income. You're physically doing something to earn that income. A W-2 employee goes to work every day. As they work for the company, they get compensated for their time. That's active income. Another example is active income would be running your own business as a sole proprietor. The entire profit would be considered active income. So if you go out and you don't get an LLC, or you do get an LLC, but you don't make an election to have it treated as anything else, such as an S corporation or a corporation, then basically the government says that your business is you, because there's no difference between you and your business. And so if you go start this lemonade stand and you're selling lemonade on the side of the road, the idea is that you are engaged just like an employee to earn all the profit in that company. Now, let's say you go out and you hire people to be employees for you and run your lemonade stand for you. The government still considers that, even if you just sit and drink lemonade all day, making sure that those employees are working, or even if you drive away and don't even have any, you hire a manager to run the lemonade stand who is being manned by a couple employees, and you drive away and you're not even involved at all, because it's a sole proprietorship, it's still considered active income. Now there are some nuances and stuff in there. We're not going to get into that kind of stuff, but that's still considered active income. You are the one that owns the business, and you are one according to the eyes of the government, according to the federal government, and so all the income out of that is considered active income, and it's taxed the same way as a W-2 employee. Other ideas of active income would be you own a corporation. It could be an S corporation or a regular corporation. Well, if you part of that would be being a shareholder, the owner, and that's different. We'll talk about that in a minute. That's passive. Or you are, but if you're the one running it and you get wages out of the company, then that's the same as you being a W-2 employee, and you're making wages. So wages are always active income, because you're the one getting your time that you give is being compensated by the business. Even if you are the 100% shareholder, if you're working for the company, you're supposed to be getting a W-2 as well. So those are examples of active income. Passive income. Passive income is the idea that really your money's making money for you. So great examples of that are investments in stocks, bonds, loans, crowdsource funding. You're getting interest back. Any type of investments. So investments could be they could be intangible assets like stocks and bonds. They could be physical assets like real estate. So what you do is your money goes into it, you invest into it, and then you're getting some sort of return, whether that's rental income or capital gains or dividends or interest, or whatever it is that you're getting back. You're not physically doing something to earn that other than maybe like putting the money into the investment or signing a document or maybe doing a little bit of research, right? So the idea is your money is mainly doing the work to make you more money. Okay. Taxes. So active income and passive income can both be considered regular income for tax purposes. Depends on the type. Active income is always ordinary income for taxes, meaning uh, ordinary tax rates, your standard tax brackets, income tax. Investments could be either ordinary income, depending on the type of investment, or long-term capital gains, which actually have favorable tax brackets. So the active income is always subject to Medicare. Well, okay, I shouldn't use always. Most of the time, active income is subject to Medicare and Social Security tax. I guess another example of passive income would be royalties. So, like you write a book and you sell it on Amazon, and so you get royalties for every time the book sells. That would be passive too. So but active income always subject to Medicare and Social Security tax, or usually, most likely. There are some other caveats in there. Passive income usually is not subject to Medicare and Social Security tax. Now, there are some disclaimers and nuances there too. So, for part of uh, uh, Obamacare, I guess is the best everybody knows it by, the medical, uh, the bill that the act that supposedly redid our entire insurance and medical system, right? That added what's called net income or net investment income tax, NIIT. That is Medicare and Social Security tax on basically high net worth or high levels of investment income. So basically the idea was, if you only have passive income because you're high net worth and you have lots of investments and you're completely living off of passive income, you still should pay some Medicare and Social Security tax. So that's basically what that is. So it is possible, if you get enough of it, you're going to still owe some Medicare and Social Security tax on it. And then the other side, on the active side, you could be a real estate professional that owns a lot of real estate investment properties, rental properties, and we consider that you are actively participating in property management, property rentals. Therefore, it is active income. But real estate investments are still investments, so they're not subject to Medicare and Social Security tax because they are investments. Now, your property management portion of that may or may not be subject to Medicare and Social Security tax, depending on how you've structured your business. So those are some of the nuances. So we have active, which basically means you are personally engaged in earning the money, and you have passive, where your money is earning money for you. The big issue between active and passive is passive losses cannot be, well, they are to $3,000, but for the most part, they cannot be deducted against active income. So if you are making $100,000 on a W-2 wage and you decide to invest in crypto and you take a massive loss, then that loss is not going to lower your W-2 wages. It's capped at $3,000, which means instead of being taxed on $100,000 of W-2 wages, you're going to be taxed on $97,000 of W-2 wages. So $3,000 really is immaterial, but passive losses can't be deducted against active income. So that's kind of the big issue there. And there are ways around that as well, which is why we say, okay, I'm a real estate investor. I have 20 properties. I'm constantly working in it. I have my real estate license. I'm a real estate professional. We're going to say that as a real estate professional, you are actively involved. We're changing the nature of those investments to active. Now the losses in the real estate investment can deduct against W-2 wages without causing, if you ended up making profit, it wouldn't cause Medicare and Social Security tax, but while the losses would be deducted against your active income, W-2 wages. So there are, loopholes. I don't like to call them loopholes. They are built into the tax code to incentivize people to do certain things. But they're strategic ways that you can put together your tax situation to pay the least amount of taxes. So that's kind of the difference between active and passive. Active, you're working in it. Passive, your money's making money for you. Passive losses can't be deducted against the active income. Active is always subject to Medicare and Social Security tax, and passive, for the most part, is not subject to Medicare and Social Security tax. So those are the biggest difference. And let's see, I'm not sure how long this is. I'll go ahead and talk about revenue streams, because this kind of goes into the same thing. So revenue streams. So let's say you start a business, you have an LLC, and this is your operating company, right? So the operating company, whatever it is you're doing, you're buying and selling toilet paper, you're buying and selling TVs, you're a fitness coach, you're a CPA offering tax advice, right? Like this is your active company, your primary operating company. You're going to want to limit risks between revenue streams. Depending on what niche or industry you are in, it's going to have higher or lower risk, right? Like for example, a doctor carries high malpractice insurance because there is a high risk of hurting somebody in surgery. So they have malpractice insurance. So there's more risk there. Well, in your operating company, the active company you're working in, if you are 100% shareholder and you want to get into other revenue streams, you may or may not want to put those revenue streams in your same LLC. For example, passive income. If you go out and you want to get into stocks and bonds and other crypto type investments, there's no point in putting it in your business. And the reason why is for a couple reasons. One, it has the same tax consequences on you personally as it does if you run it through your business, because passive is not subject to Medicare and Social Security tax. So there's no strategic purpose to lower your taxes by running it through your business, especially if your business is a pass-through entity, right? If you're a traditional corporation, that's a different story, but most people aren't. This is one of the reasons why. So you don't want to go out and buy stock in Microsoft or Google or whatever with your operating company, because there's no tax benefit to it. If you have capital gains, it's going to be taxed the same way on your individual tax return if you run it through a personal name or if you run it through your operating company. Next reason why you don't want to do it is because it does create a bookkeeping headache. Like it's a little bit more complicated in bookkeeping and record keeping for investments. There are some nuances there that increase the complexity of your bookkeeping for absolutely no reason whatsoever, because you could just run it through you personally and it goes to your individual bank account. Third reason is in the event of something else negative happening to your business, such as a lawsuit, and you lose. Every state's different. I'm not an attorney, so I don't know. I can't go into this into great detail, but anything that is owned by your LLC, if you lose in a lawsuit, could potentially be at risk in that lawsuit. So if you have a bunch of stocks and bonds owned by your LLC or your corporation, being taxed as an S corp or whatever, underneath that LLC umbrella, and you lose a lawsuit, you could be potentially losing your stock. Whereas if you had it in a personal investment account, the risk is supposedly not there, or not there as bad or whatever, right? Because the LLC is protected the lawsuit gets locked up in the LLC and all your personal assets are protected. So that's one, those are like three reasons why you wouldn't want passive investments in the same LLC as your operating company. Another example would be real estate. Real estate has another issue. There are tax consequences if you put real estate in a operating company. So what you'll find a lot of times is most businesses, traditional corporations, anybody that has real property, they're running a brick and mortar. The traditional structure is to have two LLCs, one a property holding company and one the operating company. And then the operating company rents the real estate, the brick and mortar building from the property holding company. We separate it. Why do we do that? Well, we don't want to combine that risk. If the operating company gets sued, then we're going to potentially affect that brick and mortar. But if they're in separate LLCs, there's a layer of protection there. Tax consequences, they're going to be the same. Like if you're getting depreciation out of a building, doesn't matter if it's under a property holding LLC, under your individual name, or it's under your operating company, the depreciation is the same. It's not going to change. And so there's no tax benefit to putting it into your operating company. All you've done is combine risk and increase the risk on real estate. The third reason why you wouldn't want to do that is because there are negative tax consequences for putting it in an operating company. For example, if a corporation owns property, let's say you buy a brick and mortar, you contribute it to your operating company because you don't want to open another LLC or whatever. And then at some point you're like, okay, I want to sell the company, but I want to keep the building, or something else happens. Let's say you're like, well, I have kids and they're going to inherit the building, but we're selling the company, whatever. You're going to have to carve that building out into your individual name. So anytime you take property out of a corporation, it's called a deemed sell, and you have to sell it at fair market value to yourself, which means you're going to owe some capital gains tax on it, and you didn't even get any cash because you sold it to yourself. That can hurt. That could be millions of dollars of capital gains. You could end up owing $200,000 or $300,000 in taxes, and you didn't even get any cash because you had a deemed sell on a building you've owned for 20 years in your corporation, and now you want to sell your corporation, but you don't want to sell the building. So those are some nuances there. The other thing would be, okay, well, what about other active streams? So there's other active streams of revenue. So let's say you have your operating business that you're like the owner and CEO of, and that's being a fitness coach. And then you decide, you know what, I want to start a second business. I want to sell t-shirts. Okay, so we have two completely different industries. We have a service industry, and now we have a retail industry. So they're going to have different risks associated with these industries. A fitness coach could potentially injure somebody who goes to the ER or the doctor, and ultimately their insurance company sues you. A retail store, maybe you got some bad shirts or something that caused somebody to have a rash, and so they go to the doctor, and then their insurance company is suing your retail store. Well, if they're under the same LLC, they're combining risks. If you have them under separate LLCs, then they each house their own risk. The idea is we want to focus the risk that any one business creates or any one revenue stream creates within itself. We don't want to share or combine risks. Now, consequences of that, you're going to duplicate administrative costs if you have two separate LLCs. That might mean you have two annual reports you have to file with the state, two separate bank accounts, two separate credit cards, two separate sets of accounting records, like QuickBooks, and two separate tax returns. So you've duplicated all the administrative costs. Whereas if you put them under the same LLC, you might be combining risks, but you minimize your administrative costs. So those are things you have to consider with revenue streams. And so I hope this helps. We don't want our operating company really to be involved in any passive investments. What you could do is you could set up an investment holding LLC if you want it under an LLC. And then that LLC can go out and be an umbrella that owns rental property LLCs, and it owns stock investments and all those kind of things. Like you have a property holding LLC, and then you have an operating company LLC. So that would be one of the ways to do that. If you want it under an LLC, but you don't want your operating company to be involved in any passive investments unless that's like the actual nature of the business. And you also, but in other revenue streams that are other active or other, operating companies, there might be some argument to combine those or to separate them based on cost to benefit. So you have to think about that. Anyway, I hope this helps clear up some confusion about active versus passive and how we can run different revenue streams based on the type of investment it is or the type of activity it is. Anyway, till next time, have a great week.